5 years ago, two coworkers named Kristoff and Anna made the exact same salary, $82,000. Same office, same starting line. One spent those 5 years obsessed with money. 6 monitors in the spare room. Candlestick chart trades before sunrise. The other did, as far as anyone could tell, almost nothing. Today, the one who did almost nothing is over $100,000 richer. And here's the part that should bother you. That's not the exception. That's the rule. I met Kristoff at a barbecue where he pulled out his phone to show me his trading dashboard like it was a newborn. Across the yard, Anna ate a hot dog and said nothing about money at all. So I did the thing I spend too much of my life doing. I investigated all 8 of the ways people swear will build wealth. I ran the actual math on everyone and watched 5 of them quietly fall apart. By the end, I'll show you the exact trap Kristoff fell into and whether you're already standing in it. My name is Nick, and I've spent an embarrassing chunk of my one short life figuring out why some people escape the money treadmill, while everyone else just runs faster on it. If you're tired of watching your bank balance hover around the same depressing number, subscribe, no matter how hard you grind. Today, we're separating the methods that actually move the needle from the ones that just feel like they do. Quick disclaimer, I'm not a financial advisor, and this isn't financial advice. This is just a guy who reads spreadsheets for fun telling you what the numbers say. 1. You stop listening to the people selling the dream. Here's the one idea you need before we start. Every wealth method has a ceiling and a median. The ceiling is the one guy who got rich doing it. The median is what happens to a normal person who tries. Gurus sell you the ceiling. You live at the median. I'm going to call that the ceiling lie. And once you see it, you can't unsee it. And here's why it matters more than it looks. The most valuable thing you own isn't money, it's time. Because time is the one ingredient compounding can't run without. Every year you pour into one of the losing. 5 is a year of compounding. You can never buy back at any price. So getting these 8 sorted isn't trivia. It's the difference between starting the clock now and starting it a decade late. Let's start with the worst one. Number 1, day trading. Buying and selling stocks fast enough that you never actually own anything. You just rent the price for an afternoon. This is Kristoff's whole personality, so let's be fair to it. The pitch is intoxicating. You, a regular person, beating Wall Street from your spare bedroom. No boss, no commute, just you and the candlesticks. And there's the ceiling lie in its purest form. Researchers in Brazil tracked people who day traded for a living over hundreds of days. About 97% of them lost money. Of the ones who stuck with it, barely 1 in 100 made more than a minimum wage job. And they did it, the researchers wrote, with enormous risk. A study out of Taiwan followed day traders for over a decade. They found fewer than 1% could reliably turn a profit after costs, less than 1%. And here's what nobody mentions. Every trade has a spread, a fee, a tax. The market doesn't have to beat you. It just takes a small toll on every lap, while your own brain, greedy at the top, terrified at the bottom, does the rest of the damage. So no, Kristoff isn't dumb. He's smart and disciplined and playing a game where the house edge is built into the physics. Day trading isn't hard. It's nearly impossible dressed up as hard. The single most reliable way on this list to turn money and time into neither. Which brings us to number 2, crypto. And before the comments riot, I'm not saying the technology is fake. I'm saying the wealth math is not what you were sold. Most coins produce nothing, no rent, no earnings, no dividend. The only way you make money is if someone shows up later willing to pay more than you did. Congratulations, you've discovered the world's most volatile way to hand your savings to someone richer than you. And we know who that someone is. The Bank for International Settlements studied millions of crypto users and found that as Bitcoin's price climbed, the small retail buyers piled in, while the largest holders quietly sold to them. When the dust settled, roughly 3 out of 4 of those retail users were sitting on losses. 3 out of 4. The money didn't vanish. It moved from the people watching the videos to the people who don't need to. And the ride there, we saw it again in the 2025 cycle. Bitcoin hits a massive new high. The hype goes nuclear. Then it claws back 60 or 70% of that value in a few months, leaving the latecomers holding the bag. It's a loop, and in 2026, we're still watching people fall for it. Could you get lucky? Sure, people win the lottery too. But buy the thing and pray the next guy pays more isn't a plan. It's a vibe. And a vibe is a beautiful ceiling sitting on a median that just got liquidated. Fine place to gamble a little. Terrible place to build a foundation. To down, both losers. You might be sensing a pattern, and you'd be right. But stick with me, because number 3 has the slickest sales funnel of them all. The real estate hack. Not buying a home to live in. I mean the empire stuff. Buy it, rehab it. Rent it, refinance, repeat. Short-term rentals. The guy on Instagram with 12 doors by 26. So let me tell you about that guy. Call him Tyler. In 2006, Tyler had 4 properties, then 8, then a dozen. Each one bought by borrowing against the last and betting the price kept climbing. On paper, he was a millionaire. Then 2008 happened. Values dropped, the refinancing dried up, and Tyler discovered he didn't own 12 houses. He owed 12 mortgages with no equity left to pull and renters, who just lost their own jobs. The leverage that built him in 3 years erased him in 6 months. That's the hack. It runs entirely on borrowed money and good timing. And the moment either one turns, it turns on you. The short-term rental version is essentially dead. Major cities have finished their rollouts of total bans, and the passive income has turned into a full-time legal battle. Every neighbor with a spare room is now your competitor in a saturated market. Here's the honest asterisk, though. One version of real estate is real and boring. Buy a place, rent out the spare room, your own biggest expense. Because that one isn't a hack. That's just smart. The Empire version works for a few operators with capital, nerve, and timing, and gets sold to everyone else as a shortcut it isn't. Number 4, side hustles. And I have to be careful here, because this one isn't a scam. It's just wearing the wrong costume. It's extra income in a trench coat pretending to be a wealth strategy. Let's actually run one. Say you drive for a rideshare app on weekends and pull in $800 in a month. Sounds decent. Now subtract the gas, subtract the extra insurance, subtract the self-employment tax you owe yourself, and subtract the depreciation your car is silently eating every mile. By the time you're done, that $800 quietly becomes more like $14 or $15 an hour, and you hand it over every weekend to earn it. But the real problem isn't the wage. It's that a side hustle doesn't compound. You trade an hour, you get paid for an hour. The hour is gone, and tomorrow you start over. It's a faster hamster wheel, still a wheel, and it eats the one resource you most need to actually grow, your energy. Every Saturday driving strangers around is a Saturday you didn't spend getting better at the thing that already pays you. 40 hours a week. Now, the exception that proves the rule. A side hustle that becomes a real business, or one that builds a skill you can sell for more. That one graduates onto the works list, but as a permanent plan. Trading more hours for more linear dollars is just a second job with worse benefits. Great bridge, terrible destination. Number 5, and this one's going to upset the nicest people in my comments. Dividend investing. The idea that loading up on high dividend stocks is its own special road to passive income. Here's what the dream leaves out. A dividend isn't free money. When a company pays you $1, its share price drops by about $1, and now you owe tax on it. What actually matters is total return. And when you chase the fattest yields, you often grab companies paying big precisely because they're in trouble. Dividend chasing as its own strategy is just regular investing wearing a fake mustache. Fine to own, doesn't deserve its own pedestal. So day trading, gone. Crypto, gone. Real estate hacks, gone. Side hustles, gone. Dividend chasing, gone. That's 5 of the 8. If you're sitting there thinking, nothing works and the whole thing is rigged, good. Sit in that for 1 second, because that feeling is the exact moment the gurus hook you, right before they sell you the 6th thing. The truth is gentler and far more boring. 3 of these work. They just don't trend because nobody can sell a $49 course on them. This is where Anna with the hot dog doing nothing starts to make a lot more sense. Number 6. The first thing on this list that actually works. Low-cost index funds. You buy one fund, and that fund owns a tiny slice of hundreds, even thousands of companies at once. You're not betting on a stock. You're buying the whole casino and quietly collecting a cutoff every table in the building. This is what Anna did. No charts, one fund. And here's the stat that belongs on a billboard. Over 15 years, around 9 out of 10 professional fund managers failed to beat that one boring fund. 9 out of 10. The market has historically returned around 10% a year before inflation, roughly 7 after. Watch what Anna's boring fund does. $500. A month at 7% is about $560,000 in 30 years. Give it 40, and it crosses $1.2 million. And you only put in about $240,000 of that yourself. The rest is compounding, working the night shift while you sleep. There's one catch. And it isn't the fund, it's you. The average investor earns far less than the market, not because they picked wrong, but because they sell in a panic when it dips and buy back once it's high. The fund never fails. The hand on the sell button does. It's a cheat code available to everyone with $10 and patience. Number 7. So obvious the entire internet conspires to distract you from it. Raise your income. When you're starting out, your savings rate matters more than your returns. A 10% return on $200 is just $20. Earning more is the lever with no ceiling and the best odds on this entire list. Say you're 28 and you talk your way from $82,000 to $90,000. That's $8,000 more a year. Invest that gap every year at 7%. And over 30 years, that one conversation turns into more than $800,000. One slightly uncomfortable meeting. Almost $1 million on the far side of it. Kristoff stared at charts for 5 years chasing what a single raise hands. Anna for free. Getting genuinely good at something people will pay for is the highest probability wealth move there is. Nobody can sell you a course on become excellent at your actual job, so it never trends. But it worked. Number 8. The most powerful of all. And the one that sounds like your grandmother whispering through a coupon book. Your savings rate. The simple gap between what you earn and what you spend. Your savings rate controls both sides of the equation at once. It's the money you keep and feed to the index fund. And proof of how cheaply you can live. Save 15% of your income and you're looking at roughly 40 years to freedom. Bump it to 50% and that drops to 17 years. Push it to 65% and you're free in about a decade. Same person, same job, only the gap changed. A high earner who spends every dime is on a longer timeline than a modest earner who's disciplined. That's the part that breaks people's brains. It's why people like Anna, earning the same as Kristoff, end up quietly free while he's still running the treadmill. Index funds, income, savings rate, none of them sexy, all of them real. And together they're the whole machine. Now I can already hear the objection. But Nick, I know a guy who flipped houses. My cousin tripled his money on a coin. And yeah, those people exist. That's the whole trick. The ceiling is real. Somebody's always standing on it waving. But for every one of them, there are 99 you never hear from, because losing quietly doesn't make content. The winners are loud and the losers are invisible. So your feed hands you a rigged sample and calls it normal. The plural of one lucky cousin isn't a strategy. It's survivorship bias with a nice watch. 5 years on, Kristoff has 6 monitors, 100 screenshots of his green days, and a net worth basically where he started. He spent half a decade as the most financially active person any of us knew. And the market handed his returns to people who never opened a chart. Anna automated $500 a month into an index fund, talked her way into 2 raises, and stayed in the same apartment after both of them. She did nothing loud. She did everything quiet. And she's now over $100,000, ahead of the guy with 6 monitors. The whole machine is built to point you at the exciting losers, because somebody makes money every time you trade, subscribe, or buy the course. Nobody makes a dime when you quietly buy an index fund and go for a walk. So let me give you permission to be boring. The people who build real wealth aren't smarter than you. They just stopped chasing the ceiling and started building the median on purpose. Pick the boring 3 and start one this week, because 5 years from now, you'll be 5 years older either way. Spend them like Anna.